Thanks very much, Kevin. And I'm Derek DeCluet. I'm the Canada Managing Editor for Bloomberg. And it is my great pleasure to introduce four experienced portfolio managers who are experts in fixed income. We apologize for any earlier audio issues we had on an earlier panel. This panel is going to be great, and it begins with Geof Marshall. He's head of fixed income at CI Financial's Signature Global Asset Management. From somewhere in the state of New York, we've got Scott DiMaggio. He's co-head of fixed income and director of global fixed income at AllianceBernstein. Diane Young has joined us. She's a senior portfolio manager of fixed income and co-head of corporate bonds for Addenda Capital. And we have David Wolf, portfolio manager and all-around asset allocation guy at Fidelity, formerly of the Bank of Canada. Welcome to all of you.
Thank you.
And thanks very much for joining us. And I'd like to start with a really big picture question, because we've had huge changes in the macro environment over the past 8 months. Central banks do not have a lot of policy room left. Interest rates very low, probably for a very long time. Wondering if each of you could walk us through how that affects how you approach or think about the various markets that you invest in. And David, we'll start with you.
So thanks, Derek, and thanks everybody for having me. Why don't I start off just by saying, it pains me as a former central banker to say this, but I think the monetary policy regime we've gotten used to in recent decades is effectively over. It's hard for me to imagine that central bankers are going to be able to lift rates off of zero anytime, frankly, on the visible horizon, given where the economy is and likely to be, and given the ballooning of debt from levels that were already quite high. So it's a world where rates need to remain very low for very long. It's a world where central banks, I think, go back to what they used to be, which is effectively making sure markets are functioning, acting as lender of last resort, and frankly, being the government's banker. So, in that world, and I'm an asset allocator, so I run multi-asset funds, so we have a wider playground than just in fixed income. When I think of the relative attractiveness of different asset classes, nominal government and high-grade corporate bonds fall pretty far down the list. They don't yield much. They don't provide much cushion against risky asset downdrafts. And they are vulnerable to inflation, which, frankly, I think is probably an inevitable outcome of this, though it may be well down the line. So we're basically reducing our holdings of those nominal government and high-grade corporate bonds in favor of more real assets that we think can provide a bit more protection and diversification in the environment we're likely to have. So that's things like real return bonds here in Canada, U.S. tips, and a fair bit of gold, too.
How about you, Scott? What do you think of that?
Yeah, I couldn't agree more with what David said, and I'm glad I'm not a former central banker, so I'm not in that camp. I think if you listen to Powell and you listen for the past few days, you listen to Lagarde in Europe, over the past few months, the central bankers have been begging, right, for fiscal stimulus. They know that the efficacy of monetary policy is touching upon what David said. It is going to be a really important theme for us and for markets over the next couple of years, this joined at the hip theme, right, where central banks are going to have to keep rates pinned at these ultra low levels so that governments can finance themselves, and the cost of servicing that debt does not rise. So I think the central banks will support interest rates. So while it's hard to see rates rallying a lot from here, I think it's also difficult to see them selling off over the next 12 months in any meaningful fashion. I would say as a fixed income person, we still find value in the credit markets. We've had a tremendous run from the depths of March in recovery and credit spreads. The one solace that we take with valuations where they are is that we still have a tremendous amount of buying power, whether it be from the BOC, from the Fed, from the ECB, that will continue to support the credit markets, whether it be some securitized markets, the provincial markets, or the investment grade and high yield markets. So while the valuations are not where they were or not as attractive as they were 6 months ago, we still find value in that part of the market.
Diane, how about you?
Yeah, I would agree with everything that's been said. I would say we, unlike David, we operate in I operate in a fairly limited environment, pretty much Canadian fixed income, and so although those high grade investment grade corporate bonds that fall down the list for him actually fall pretty high on the list for us. I mean, we still see value in spread product with government rates so low. Even provincials still offer a lot of extra yield relative to how low our Canada bonds are trading. We also still see value in long duration assets, as much as we've said for many, many years that rates can't go lower. Not really in the camp, but rates can go lower if you believe that zero isn't the lower bound. And with that would probably come a flatter yield curve. So with still roughly 100 basis points of yield curve in Canada and roughly the same, little more in the US, I would still say there's value in long-term government bonds.
Geof, where do you stand?
Sure. So all good points that have been made. I'd say, unconventional monetary policy is now conventional. I would characterize this environment as, pre-yield curve control, where we can expect, government bond yields throughout the curve to be very range bound and probably negative on a real basis. And so I think I ask myself, what does that mean for portfolio construction? I think investors are going to have to take more risk, whether it's more duration risk, credit risk, liquidity risk, foreign exchange risk. Probably have to expect more volatility out of various other asset classes, less of diversification benefit of fixed income. Expectations are going to have to come down, and I think you're going to have to get creative. I think you're going to have to get creative on a fixed income basis. Looking at gold as a diversifier, U.S. dollars to a Canadian investor, and I put it out there. Eventually, longer term, even Chinese bonds, because that's kind of the last rate structure that can really collapse and generate the gains that would offset, credit or equity losses. So we're going to have to get creative.
Since this is the Canada Fixed Income Conference, we'll turn our attention home for a second. There's a great deal of talk about fiscal policy right now, especially, as you say, monetary policy is becoming a bit limited and what more it can do. We had a big throne speech yesterday without a lot of numbers, but with a lot of ambition. How much do you guys, as investors in Canada, think about the big picture fiscal question coming out of Ottawa and the provinces? And does it really matter that we're having this debt spree? Diane, why don't you take that one to start?
Sure. So as you said, we did have the throne speech yesterday, and I think the theme there was there's something for everyone. Definitely left-leaning and lots of ambition, as you said, for lack of austerity. I would say lots of spending expected, and certainly becomes very political when you talk about a government that's operating in a minority. So there does need to be some support. I guess our thought is that there will be. And does it matter in the short term? I mean, take your pick. Every developed nation out there is spending and will continue to. The U.S. certainly fighting with the election in the meantime, but the spending will continue. And as much as our monetary policy experts have agreed, it does need to come from the fiscal side. So we would expect that it will continue. The biggest question is what does that mean going forward? And of course, what we think is that it just limits growth down the road. I mean, when you take on the massive amount of debt that developed nations have been and continue to, it's not as productive. It's not like private debt. It just doesn't generate the kind of growth that we're going to require. So it just adds further pressure, downward pressure on inflation and on growth going forward. I mean, the middle class is going to bear the brunt of it in Canada, as much as the big comment was that's who the government is trying to support. That's exactly who's going to pay for it in the form of higher taxes later on.
How's our former central banker feel about it, David?
Well, I'll take, I guess, a slightly different tack than Diane did. I think it very much does matter, this aggressive spending and borrowing and effective monetization that we're seeing, but it also matters in a relative sense in Canada versus other countries. So one can say, yeah, everybody's doing it, so it doesn't make a difference. Canada is in a more challenging position than most countries if you look at either the level or trajectory of debt. To give you a quick statistic, so if you take total economy debt in Canada, so gross and all sectors, so all levels of government, household, corporate, et cetera, that number was about 250% of GDP in the early 90s when we got downgraded, et cetera. It was 350% of GDP at the end of last year. It's now 450% of GDP. So, you tacked on a year's worth of output in debt in 27 years, then you did it again in 6 months. And that debt level is higher than, I think, pretty much every G20 country except Japan and possibly France. So I'd have to look at the Q2 data. But the point is that everybody is doing this, but we have, I think, greater challenges in terms of sustaining this fiscal trajectory than most. And one of the interesting bank shots of that from a market point of view is there's actually a very interesting leading relationship between the relative indebtedness of Canada versus the US and the relative exchange rate of Canada versus the US. And so I think that higher weight of debt, to Diane's point about that retarding growth in the future and generally being a headwind for the economy, may express itself to some degree in the exchange rate as far as Canadian dollar depreciation.
I see Geof nodding a bit here, so why don't you take it, Geof?
Yeah, I'd say that's a fair comment. I think, a lot of this is going to come down to currency depreciation as a lever that central bankers would like to pull. And I'm thinking, last week, Christine Lagarde at the ECB was very cautious on speaking to the strength of the euro. I think cognizant that you don't want to get into a currency war, with your neighbors and your trading partners and particularly the Trump administration. But, I think currency is going to be part of it. Canada, I think, lacks a certain degree of monetary policy independence from the Fed, and doesn't have that reserve currency strength that the U.S. has in terms of being able to run higher deficits and higher debt levels. And we've got a lot on our plate. We've got to bridge the economy through COVID. We've got to. This seems like it's an agenda item to address income inequality and climate, and that all translates into, I believe, higher marginal tax rates, which itself is going to impede growth. So there's some short-term and some long-term challenges here, which I don't necessarily see ending well. But again, it's relative.
For those who know their history in Canada, we were certainly reminded about that lack of reserve currency point in the 1990s when we had some trouble. Scott, you want to take this one as well?
Yeah, I'll just make a few comments. I'm Diane in that if you're not going to spend now, when is the time to spend? So I do think fiscal is the only game in town right now. If that money is used for productive purposes, which we can all smirk at because chances are a lot of it will not be, right? That will be a bit of a waste that will lead to lower growth in the future, higher taxes. Agree with all of that. I think the one point I would take a disagreement on is if you look at Japan. I mean, Japan has kind of kept this game going with massive fiscal deficits in a low inflationary environment by increasing the size of the central bank balance sheet. I don't think there's any reason why Canada, the U.S., Europe cannot go down that path for the next several years. Eventually, the day of reckoning will come, whether it be in the form of a currency crisis or runaway inflation. But I think for the next 24 months, this has to be the path that central banks and governments follow.
I'm going to ask you guys about inflation in a sec, but before I do, first of all, I'd like to remind the audience that you have an opportunity to submit questions. We would love your questions. There's a function on the right-hand side of your screen. And before I get to inflation, I want to ask about provincial debt because Canada has a somewhat unique feature in having a lot of responsibility and actually quite a lot of debt at that subnational level. Diane, you mentioned it in your opening remarks that you kind of like some of the spreads. Can you just talk a little bit, if you would, about what you see in the provincial market where some of the opportunities might be?
Yeah, I think, you kind of have to know the Canadian provincial market to understand there's a bit of the haves and the have-nots, and certainly Ontario, BC, and Quebec tend to be the the largest and the most liquid provinces, the ones that are able to fund themselves internationally. Alberta obviously facing some pretty unique challenges right now with the energy market, and certainly their valuations have reflected that, as have their deficits. I think that there is value in essentially a quasi-sovereign type of an issuer, which is relatively how they're seen. However, to David's point, I mean, there is a lot of debt being taken on by these provinces. A lot of, that is going to have to be funded later on, and they all have their unique sets of challenges. So as much as I say, there's valuation there, it's not to say if the international markets or the international audience that has been a large contributor to funding these provinces were to take a back seat, I think that you would see spreads widen and you would see, rates higher, that it would just be more difficult for them to fund themselves at an attractive level. So that would be one concern. It certainly hasn't been an issue. And again, to the point made earlier, with the central banks essentially backing the provincial debt market, much like they have the corporate market, it certainly has been a very, efficient kind of way that they can fund themselves for now. If we talk about 2-3 years down the road, perhaps it could be more of, to David's point, they could be more into a problem running themselves with such high deficits.
Anybody else want to take that on, the question of provincial finances and value or not in provincial debt?
I think I would add to Derek. I think I would add to Diane's comments. Decent carry. A certain degree of gap risk outside of, or even within, the big four: Ontario, BC, Alberta, Quebec, where points in time like March where it's hard to get a bid on paper. And if we're going to take that illiquidity risk, we've been increasingly focused on the municipalities where we're actually seeing, better credit quality, smaller issuers, but limits on deficit spending, for example, and fiscal support from provincials, the provinces, and the federal government. So better credit quality, but we're taking some liquidity risk. So we're finding decent carry there.
So I'm happy to chip in. Yeah, sorry.
Please do. Yeah.
So this is, partly in answer to the provincial question, but also getting back to Scott's comments, which I think are critically important. So, the trajectory, whether it be of provincial debt, broader federal debt, whether you're talking about Canada or the rest of the world, I think one of the critical questions for our time is Japan unique? In the sense that, as Scott said, Japan has been running these massive deficits and gross debt levels for years without, the economy obviously hasn't been very good, but you haven't had runaway inflation, you haven't had market stress associated with that. And so, is Japan unique? Is there something about the Japanese economy and, it's more internal focus in terms of the owners of that debt that make it unique? Is it unique because Japan was basically the only country doing this for many years, and now every country is doing it? And we don't know the answers to that, but I think that's sort of the question for our time that's relevant not only to Canada, but really around the world.
Yeah, it's a huge one, and I guess it's a good segue into a question about inflation. So forget the short term, but if we're thinking of a more medium term time horizon, over the next, say, 5 to 10 years, could each of you sort of give me what your thoughts are on the potential inflation dynamics? And Scott, we'll start with you.
Yeah, I would think that our view is inflation is definitely on the upward trajectory, and that we've kind of left the deflationary world that we've been in for the past 10 or 15 years. I think that is really dependent upon monetary and fiscal acting in unison and continuing to step on the gas. When I think about the debt that we have, the easiest way to deal with the debt burdens, right? Look at the way we dealt with them after World War II, was really via financial repression, right? Try to generate nominal GDP that is significantly above the cost of financing that debt, and over a decade or several decades, right, eventually pay down, that amount of debt. So I think inflation. I think if central bankers, whether it be and fiscal authorities, whether it be through something like MMT, if they're committed, they can generate inflation. And I think much like the 50s, and the 60s, they have to generate that inflation to deal with the debt burdens.
David.
Yeah, I fully agree with Scott here. I mean, a former colleague of mine used to say, you know, there are three ways out from under a debt burden. You can grow your way out, you can default your way out, or you can inflate your way out. Growing your way out doesn't look very likely in this world. Defaulting your way out is never necessary for a country that issues its own currency. And so inflation is kind of the path of least resistance. And, you know, whether you come at it, you know, as a modern monetary theory type of person, or with a more kind of, you know, classical macroeconomic framework, or you look at the political economy of it, the fact of the matter is there's no barrier to monetary and fiscal policy, as Scott said, working in unison until they find where that inflation constraint is. And eventually they're going to find it. And I don't know if it's a year, 3 years, 5 years, you know, 6 months, what have you from now. But to me, this is pretty much inevitably the place that it ends up. And inflation protection, to my earlier point, is still relatively cheap. It's one of the reasons we're buyers of it.
Diane.
Yeah, I guess we have a little bit of a different view that we just certainly in the next 2 to 3 years don't see really any inflation. I mean, typically you need a lot of credit growth and things like that to spur inflation, and we're just not seeing that. As well as if we look at history, I mean, I have no argument that the monetary authorities will try to spur inflation. That is absolutely their goal and their wish. But we've been hearing that for 20 years back in the Bernanke days. So I think they will do everything they can. And I think we're getting maybe we get some false starts. But I think even when you listen to Powell, I think even they've a bit resigned themselves to saying they're hoping for it, but I just don't, you know, the large output gaps that we're seeing and the amount of fiscal stimulus that really is just keeping us afloat right now eventually will be weaned off. We don't see it in the next, say 2 to 3 years.
Any dissent, Geof?
Diane, give me a call if you want to sell your ribbies later on today.
You just made a trade.
No dissent on my point. I would say, look, I think there's a political element. All good points made, but there's a political element where, you know, if we have now started down this road of deglobalization, whether it's a political issue or a COVID and redundant supply chain issue. But I think deglobalization raises, you know, the cost of goods, and that where we've been in, you know, a 40-year secular trend of globalization. Technology is part of this, and I don't think that technology element in terms of lowering prices and costs goes away. I'm just not convinced that deglobalization is enough to get, you know, inflation sustainably above, 2%, past 3, 4, or 5 years from now. So I agree, you know, inflation is needed to deal with this debt burden. I'm just not sure if we get it. And so further down the road, I think there will be some sort of great reckoning.
We're going to turn our attention to the corporate market now, and I had a good question from the audience. There's been huge issuance really around the world this year. Lately in Canada, we've even seen issuance for really hard hit by COVID sectors, airports, long-term care homes, and so on. Like each of you to kind of assess where there might still be value or opportunity in the Canadian corporate market. And Diane, maybe I'll throw that one to you as a starting point.
Sure. Thanks, Derek. And as you mentioned, we have seen record supply in the corporate market, investment grade corporate market this year. Certainly in Canada, we've had a bit of a tale of two cities where you've got the haves and the have-nots, you know, communications, telco, most of the financials doing great. And then you've got the energy and the real estate sector. So that's kind of how we have divided it up. When we talk about areas of value, we still do see value in the REIT sector. The good old Canadian corporate market tends to be pretty illiquid, and these tend to be pretty small issuers. So new issue game is certainly alive and well, and I would say that demand we would expect to continue just with the yields there. The other area is still energy, depending on your view on oil prices. Even if they stay here. I mean, in the Canadian market, we're talking mainly midstream and pipeline issuers, so not really direct commodity exposure. We would still see some value there. As far as trouble spots, it's hard to see defaults in the Canadian investment grade market. We wouldn't really see those really materially rising. That being said, the Bank of Canada has been pretty clear in providing liquidity to the Canadian market on the corporate side. However, they can't downgrades as much. So we would still see probably some rating migration risk. But as far as outright defaults, we wouldn't really have much of a concern in the investment grade market.
Scott, you've got a pretty good view of how Canada fits into the global corporate picture. What do you think?
Yeah, for us, I think there's value in banks down in cap structure, especially playing in some of the AT1 deals. That's a kind of newer instrument to the market, but is a fairly well accepted instrument globally. So there's concerns in Canadian banks about the high exposure to real estate and to housing loans. A lot of those loans are insured. But we know the Canadian banks are going to have to take more loss provisions over the next 6 to 12 months. They've started to do that, but that number will probably increase. Despite all that, we still view the banks as in good shape, and we find value in the sub debt of the Canadian banks.
Geof?
Those limited recourse capital notes, I think, are interesting value to us. If they make up 75 basis points of the bank's risk-weighted capital assets, I think that is another $14 billion of issuance from here. That should take out about $9.5–10 billion of bank prefs, which are mostly a retail product. So this is one place I think that we actually see net issuance, bond debt taking out retail held pref debt. But I see, I think generally what we're seeing is a lot of issuance, a lot of gross issuance, but not a lot of net issuance. And we've got a spectrum auction coming up, which will probably be, there'll be a debt funded element there, but not a lot of capital projects being undertaken in Canada that would then need to be debt funded. So I'm not too bullish on net supply from here. Ongoing issuance for sure, and but not a lot of net issuance. Where we're seeing value, so those long limited capital recourse notes in the energy space as well as and the midstreamers like TRAP, like Enbridge, especially in some of their subordinated debt or hybrids, structures that have where there's a capital treatment incentive for those bonds to come out earlier than their 60 or 70 year final maturity.
David, how about you?
Yeah, just quickly, I'm less involved with the security selection specifically in terms of our portfolios. So as a top-level asset allocator, as our Canadian bond team, that really makes those security calls and sector calls. What I will say, though, a little bit bigger picture is to Geof and Scott's earlier points about the attractiveness of credit and the need to be creative. I think there's a lot of value to thinking outside the box, so to speak, with respect to different sectors and different availabilities of spread from a credit point of view, both inside of Canada and outside of Canada. And that's both to generate return, which obviously is pretty meager on the index, governments, investment grades, what have you, but also as diversification. I mean, the way that I think about it as multi-asset manager, in a 60-40 construct, the 40 used to be pretty easy, and it's not nearly as easy anymore. And so it sort of enhances the value of being able to sector and security select your way through your fixed income portfolio in order to not only add the income, but provide the diversification that folks like us are looking for.
An argument for active management. We've got only a couple minutes left, so in about 45 seconds or so for each of you, can you talk about a big theme, or perhaps even a surprise that you think could potentially shake up markets in the next 12 months? Your crystal ball, and Geof, we'll start with you.
Yeah, so I don't want to go with the obvious one, which would be the U.S. election or even the Canadian election, but I would go with a theme of greed returns. And I thought after March, we'd see a little bit more fear, which accrues to the benefit of bondholders, right? We get management teams focused on deleveraging. I thought that would come back. I'm not convinced yet that, I think in this low rate environment, we could see more debt financed share repurchases and the return of greed, which would be to our detriment as bondholders.
Scott.
Yeah, I'm going to take the easy one then, Geoff. I'm going to take like, what's a high impact, low probability event? What about a U.S. Arab Spring, right? That we do get a contested election, which is a fairly high probability. We do not have that peaceful transition in power. The Supreme Court battle that's just kind of started, does that start to lose legitimacy because one side either picks a candidate or the other side, stacks the court? Do we get to the point where there is that social unrest, troops in the street? I think that is a very kind of high impact, but low probability event for next year.
Extraordinary that we're talking about that sort of scenario. David.
So I'm just going to say ditto with respect to Scott's comment, and I hope you're right that it's a low probability type event. I'm not convinced of that, but in terms of a clear and present danger to markets, that's an identifiable risk that we're certainly spending a lot of time concerned about.
Diane, the final word goes to you.
Yeah, I'll just quickly say, because I can't disagree on the election front, that's certainly the most up and coming. But I would just say, the continued pain trade, rates keep falling. I think it's what, few people expect. And I think it's probably the one that could hurt the most.
All right. Diane Young, David Wolf, Scott DiMaggio, Geof Marshall, really appreciate you joining us today. And thank you so much.